A lot of us have come across this situation before, the question of whether to pay off debt or to invest instead. First, let's state the obvious. There are different types of debt and different types of investments, so there are no rules of thumb to deal with this conundrum. I'll address the differences so you can be armed with the right information to make your own decisions. Let's get straight into it. To be financially better off, you would want to choose the option that either charges or pays the highest interest rate or rate of return. Yes, it is true that the interest rate is not always fixed, and certainly rates of return are hardly predictable, hence why there are no rules of thumbs you can depend on. However, let's say you predict an investment to net you on average 8% per annum, and you have some debt that is costing you 12% per annum. Then, at least from a financial point of view, you will be better off paying off some or all of the debt before making an investment. Some of the most expensive debt, such as credit cards, should probably be paid off first, as these are currently averaging over 20% per year, and many are charging over 30% per year. It would be foolish to expect your investment to consistently outrun these rates of interest on credit cards. On the other end of the scale, mortgages tend to charge relatively low rates of interest. Some of the lowest currently are a little over 3% per year, fixed for 3 years or 5 years. It would not be unreasonable to think that an investment would outrun this level of interest. But which investments might you ask? Well, you might consider a practically risk-free investment as a fair alternative, such as US Treasury bonds, which are paying an interest rate of 4.625% until May 2044 and are available at par value. This means that you'll be earning about $1,000 per year, practically for free. But there are investments that earn much more, I hear you crying. Yes, there are investments that earn more, as long as you're willing to take on some risk. In this case, the risk is relatively low because if we're comparing to a mortgage, which runs for many years, then the time horizon is on our side, and a longer time horizon helps us to ride out the natural ebbing and flowing of the financial markets. We don't care so much about the daily, weekly, or even monthly volatility in the markets, as long as we're making a decent average return during the course of our investment time horizon. And this is why many individuals will happily make investments despite having a mortgage to pay. There's little financial urgency to clear the mortgage before making investments. As we can see here, the markets, when viewed over the short term, is very scary. But when viewed over a number of years, then the graph looks much better and the returns are much more dependable. Yes, there will be what's called black swan events that no one expects that hit the markets hard, such as COVID. But with time, we can allow the markets to recover. And so, over several years, we can expect a diversified portfolio of assets that largely track the global markets to net high single-digit returns. Furthermore, there are actually loans specifically for investing. These are called margin loans, which are secured against a portfolio of financial assets, allowing the individual to borrow specifically for the purposes of investing. Margin investing was more popular when interest rates were lower a few years back, and it's a way to leverage your investment, allowing for magnified returns. This is exactly the same way that low-cost mortgages will magnify the return on investment of your property when increasing in value. Sometimes we don't make decisions purely based on financial matters. Even though it could be better to invest than to pay off some of the debt, there are reasons to delay the investment. For many homeowners, the mortgage payments are a very significant part of their monthly expenses. And even though the interest is reasonably low and it makes financial sense to invest instead of paying off the mortgage, it could be that it feels too burdensome to have such a large mortgage over their head, and it seems better to clear some of the mortgage first. This is a perfectly reasonable conclusion, and I don't blame the homeowners for doing so. It is estimated that the average mortgage to income ratio is around 70% in Hong Kong. Finally, choosing between debt and investment is very personal too. Some people just don't like having debt. It makes them feel uncomfortable, and some people are not confident with investing. so they would rather choose to pay off some debt first. Others are more motivated at the prospect of making money, and they feel comfortable about the low interest rate on their debt, so they put their money into investments with a goal to make good returns from the markets. The overall aim is to make consistent long-term returns from the financial markets or via other means. Overall, you would most likely want to clear credit cards first and other high-interest debt that is overly burdensome on your balance sheet. Don't be a slave to high-interest debt and only buy what you can afford. After which, start investing to create an income, to generate returns. It's not particularly difficult. Perhaps you would like to reverse the role and actually lend money, perhaps to the US government using US Treasury bonds, and earn interest. That's essentially what bonds are. But you make your own decisions. It's a personal preference ultimately. We do what we feel is right for us. Thank you for joining me on this episode on debt versus investment. Let us know what other topics you would like to hear about. Subscribe to keep up to date of future episodes, and I'll see you on another episode of Money Matters.